Welcome to this deep dive. We're here to cut through the noise and get straight to the core insights. Today, our focus is SMC Global Securities Ltd. We're going to unravel their latest Q1 earnings report. This is for their fiscal year 2026, the quarter ending June 30th, 2025. The report just came out today, July 26th. And, our mission here is to take these numbers, these complex reports, and really distill what they mean. It's about the story behind the figures, the company's health, its strategies, and, well, what it means for you. And there's a really interesting paradox right from the start. We see this significant jump in revenue, a really big one, but then a notable dip in profit. Feels a bit counterintuitive, doesn't it? Okay, let's unpack this. So, starting with the big picture, those top-line numbers from the consolidated results. Total revenue from operations for Q1 FY26. It hit 42,508.81 lakhs. That's over 425 crores.
Yeah, a huge number.
Huge. And compare that to Q1 last year, just under 24,800 lakhs. So it's almost
Worth a jump.
right. And total income also rose significantly from around 25,000 lakhs to over 42,500 lakhs. So on the surface,
Looks great. It certainly looks like fantastic expansion on the revenue side, absolutely.
Right.
But, well, here's where that paradox really bites. Despite all that growth in revenue, the consolidated profit after tax for this quarter, Q1 FY26, it actually fell. And quite sharply.
Phil, okay.
Yeah, down to 2,995.01 lakhs. That's down from over 5,300 lakhs in the same quarter last year.
Wow, okay. That's a big difference.
It is, and that flows right through to the earnings per share, the EPS, nearly halved, dropped from 5.06 down to 2.84.
Okay, so less profit per share for investors.
Exactly. And interestingly, we see a similar pattern, maybe even a bit more stark if you look just at the standalone results, the parent company itself.
Right, the core entity.
Their revenue from operations dipped just slightly, from around 24,780 lakhs to 24,610 lakhs, barely a change. But the profit after tax, that fell off a cliff almost, from 4,610 lakhs down to just 2,283 lakhs. Yeah. And the standalone EPS reflects that too, down from 4.41 to 2.188. So this immediately, raises a really important question.
Where did the profit go?
Precisely. With consolidated revenue soaring, why is profitability taking such a hit, especially within the main company itself?
That really is the core mystery here, isn't it? And to figure it out, we can't just stay at that top level. We need to dig deeper, peel back the layers, and look at SMC Global's different operating segments. I think this is where it gets really interesting. They basically operate in three main areas, right? Broking, distribution, and trading.
That's the big one.
Then insurance broking services.
Yep.
And financing activities.
Exactly. And when you break down the profit before tax and interest for each of those, segment by segment, comparing this Q1 to last year's Q1, well, a very clear trend emerges.
Okay, what does it show?
Well, let's take broking, distribution, and trading first. Profit there actually decreased. It went from about 7,638 lakhs down to 6,320 lakhs.
So down in their main business line.
All right. Then, insurance broking services. Smaller numbers, but same direction. Profit went down from about 301 lakhs to 242 lakhs.
Another dip.
And then financing activities, that also saw a pretty significant profit decline, from roughly 4,077 lakhs down to 2,873 lakhs. So across the board then? Across the board. That's the key takeaway here. While the consolidated company, brought in a lot more revenue overall, the profitability within each of these core operating segments went down. So if you connect that to the bigger picture, it suggests something's squeezing margins in each area. Could be higher costs, maybe more competition.
Or investments, things that haven't paid off yet.
Could be investments too, yes. Things that are weighing on current profits. But this broad-based decline in segment profitability, that's really a major driver behind that overall consolidated profit drop we saw, even with the impressive revenue numbers.
That makes sense. So growth is happening, but it seems less efficient or maybe more costly right now. Okay, let's pivot a bit. Let's talk about funding. Because for a financial services firm like SMC, how they manage their money, how they fund operations is absolutely crucial. And it's interesting. The board just approved raising new funds today.
Right. Fresh approval.
But they've already been active here, haven't they? They raised a pretty substantial amount back in April.
They did. On April 24th this year, they successfully raised 12,030.42 lakhs. That's over 120 crores.
Through NCDs, right. Non-convertible debentures.
Exactly. Secured, rated, listed, redeemable NCDs issued to the public.
Can you just quickly explain what NCDs are for anyone less familiar?
Sure. Think of them basically like corporate bonds. A company borrows money from the public or institutions for a fixed period, promising to pay interest and return the principal. Non-convertible just means they can't be converted into shares later.
Got it. So it's debt.
Yep. Debt, yes. And the money they raised, the documents state it's earmarked mostly for working capital requirement. That's at least 75%. And the rest up to 25% for general corporate purposes, sort of general business needs.
Okay. And what about security for the people buying these NCDs?
That's important. These specific NTDs are fully secured. They have what's called a pari passu charge over the company's trade receivables and their margin trading facility receivables.
Meaning?
Meaning, basically, that the money owed to SMC by its clients serves as collateral. If things went south, the NCD holders have a strong claim on those assets, equally alongside other secured lenders, and there's a minimum security cover required 110%. The auditors have confirmed that cover is being maintained.
And crucially,
the auditors also confirmed that all the interest payments on these existing debentures have been made on time, so they're meeting their current obligations there.
Okay, that's reassuring. But now, today, they've approved raising more. Yes, the new proposal approved today is to raise up to another 15,000 lakhs, that's 150 crores, through another public issue of NCDs.
Right, another tranche.
So, okay, they're raising quite a bit of debt, both recently and potentially more soon. How does this square with that profitability picture we just talked about? What does it mean for their overall financial health? We need to look beyond just, revenue and profit. Let's get into some of those crucial financial health ratios, especially with this increasing debt load. What are they telling us?
Okay, good question. Let's look at the debt-equity ratio first. This tells you how much debt they're using relative to shareholder equity. On a consolidated basis, it actually remained pretty stable. It was 1.36 back in March 2025, and it ticked up just slightly to 1.37 in this latest quarter, Q1 FY26.
So not a huge change there.
Not huge, no. The standalone ratio for the parent company is lower, 0.99, but that did creep up a bit more from 0.88, so slightly more leverage on the parent company level. But here's where things get perhaps more revealing or maybe concerning. We need to look at the debt service coverage ratio, the DSCR, and the interest service coverage ratio, ISCR.
Right, the coverage ratios. Explain those quickly.
Sure. DSCR basically measures if a company's cash flow is sufficient to cover all its debt payments, principal, and interest over a period. ISCR looks specifically at whether earnings are enough to cover just the interest payments. Higher is generally better.
Okay. And what happened with those for SMC?
Well, they both saw pretty significant declines.
Huh.
The consolidated DSCR, it dropped sharply. It was 0.63 in March 2025. There's a Q1, just 0.20.
0.20, that sounds
Yeah.
low. Below 1.
It is very low.
Yeah.
Below 1 generally indicates that earnings weren't enough to cover total debt obligations in that period. Now, this can fluctuate quarterly, but it's a steep drop.
Okay. What about the ISCR, just covering interest?
The consolidated ISCR also decreased, though not as dramatically, from 1.92 down to 1.70. Still above 1, meaning earnings covered interest payments 1.7 times over, but definitely lower than before.
And standalone?
Similar story on the standalone side. DSCR dropped from a healthier 1.31 down to 0.67, again below 1, and the ISCR decreased from 2.00 down to 1.74.
So while the auditors confirmed, they met specific loan terms.
Yes, they confirmed compliance with specific covenants.
These broader ratios suggest things are getting tighter, less breathing room to cover debt from earnings.
That's exactly what they suggest, a tighter squeeze. It raises questions about their capacity to comfortably service this growing debt load if profitability doesn't improve.
Okay, this definitely ties back to that initial paradox, doesn't it? More revenue, less profit, and now tighter coverage ratios. So how are their actual efficiency and profitability margins looking? Is it simply costing them more to generate that extra revenue?
Well, the margins paint exactly that picture. Let's look at the consolidated operating margin. That basically shows profit from core operations before interest and taxes as a percentage of revenue. It declined. It was 10.81% in March 2025, and it fell to 9.02% in this latest quarter.
So less profitable operations per rupee of sales.
Correct. And then the net profit margin, that's the bottom line profit, after all expenses and taxes as a percentage of revenue, that also fell. It went from 8.27% down to 7.05%.
Okay. And similar trends for standalone.
Yes. Similar declines in the standalone margins, too. So we connect this all together.
Yeah.
It really reinforces that core idea.
Yeah.
Yes, they're generating significantly more revenue, especially consolidated, but they're doing it less profitably than they were before.
Less bang for their buck, essentially.
You could put it that way, and that flows directly into the lower overall profit figure, and as we just saw, puts more pressure on their ability to cover costs and service that debt.
Right. So let's try and wrap this up, bring it all together for you listening. What we've seen with SMC Global Securities in Q1 is really impressive revenue growth, especially when you look at the whole group consolidated.
Definitely a strong top line.
And it's a big but, this was overshadowed by a pretty noticeable drop in overall profitability. And importantly, that wasn't just one area dragging things down. All their key operating segments actually showed lower profits compared to last year.
Broad-based weakness in profitability.
On the funding side, they've been actively managing things, raising money through those NCDs. They seem to be keeping things secure and meeting payment terms, which is positive.
The security structure and payment record look okay based on the disclosures.
But those crucial debt coverage ratios, particularly the DSCR, have fallen quite significantly. That suggests potential pressure, right? A tighter situation in terms of covering debt from current earnings.
It certainly indicates less headroom than before. It raises, I think, an important question for anyone looking at the company long term. Well, how are they going to balance this? They're clearly still in growth mode, raising funds for working capital for expansion.
Implied by that fundraising, yeah.
Right, but they need to balance that against these current trends. Declining profit margins, weakening segment performance, and those tighter debt service coverage ratios. Will the investments they're making now start to pay off soon in terms of better profitability? Or will that growing debt burden become more of a challenge if margins don't improve?
It's a really delicate balancing act they need to manage.
Absolutely. It's the classic growth versus profitability tension, amplified by leverage.
Exactly. And that's something, we really encourage you to think about, not just for SMC, but for any company you follow. Look at that dynamic interplay. Top line growth is great, but how does it translate to the bottom line? How is profitability trending? And how does the company's debt level, its financial leverage, fit into that picture? Especially when markets get volatile. So when you look at these financial reports, remember the real story isn't just revenue in isolation or profit in isolation. It's about how effectively that revenue is being turned into sustainable profit and how well the company is managing its financial obligations along the way.
Finding that balance is key.
It really is. It's all about finding that balance between pushing for growth and maintaining financial health and efficiency. Thank you for joining us on this deep dive today. We hope this breakdown was useful, and we invite you to continue your own exploration of these really vital financial concepts.